It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being with us. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the show. With me, two certified financial planners. One's a CPA.
That's right.
Certified financial planner Josh Gregory and CFP CPA Ryan Fair.
That's right. Hey, you can think of tax planning as the art of making the right proactive decisions with your money. So when it comes time to do your tax preparation, you'll like the results. So today's episode, we're going to be sharing our top tax planning strategies for 2019 and answering your questions with special guest and CPA, CFP Ryan Fair.
Wow, you guys make it sound way too fancy.
And speaking of questions, so what's the best way to buy a car in retirement? That's a great question we have from Lauren. We're going to be taking in the second half of the program. If you have any questions, we'd love to hear from you. Any comments, have any needs, please reach out to us. You can do so a few different ways. Find us online, wisemoneyradio.com. You can call or text 574-222-2000. That's 574-222-2000. And then all over social media, wherever you're at, we're there too. So Facebook, YouTube, Instagram, just search the Wise Money Show. You can submit questions that way. You can get all the content that way as well and stay connected to the show. Thank you very much. All right. We talk a lot about tax planning. Ryan, you do tax preparation. What's the difference?
Yeah, good. So tax preparation, that's what everybody thinks of when they think of a tax guy. So that's the once a year you're required to file an income tax return with the government, report all your income and your deductions, and make sure you've paid enough tax, and if not, you pay additional tax. Mm-hmm. That's the tax preparation side of the tax man. Tax planning is optimizing your situation so that when tax preparation time comes around, you are paying the appropriate amount of tax, whether that, there's so many different opportunities to plan to, sometimes it sounds strange, but you may plan to pay more tax in a certain year than you may have otherwise. There's lots of opportunities to perfect your tax picture.
Yeah, I mean, isn't it better to pay a little more tax today so that you don't have to pay nearly as much tax? You can pay a lot less in the future. That's tax planning, right?
Yep.
Sometimes tax planning, though, is just as simple as pausing partway through the year and taking a snapshot of where you think your tax return is going to land if you just continue on the pace that you're in. This is really just a matter of confirming that there's not some sort of a problem brewing in a tax return, especially during years of transition where you've changed jobs or maybe you've life circumstances. You're married now, you have kids, you started a business, you retired. I mean, there are so many life transitions that happen that change your tax picture, and it's important before you get to your CPA's office to prepare the return in the spring. Long before you get there, it's important to know what is the pace that you're on anyway, because during the calendar year, there's still time to actually have some influence and change the picture if you don't like what you're seeing.
Here's what tax planning is. You are just starting in a job, you've recently graduated, your income's pretty low, and they default your contributions into your 401k 5% pre-tax. And you sit down with the CFP and they say, nope, that should be Roth. Okay, that's tax planning. Tax planning is also, all right, I'm about to retire. I'm 62. I'm going to have Social Security coming in, and I'm going to be pulling a certain amount of money out from my 401k IRA, and so be it. Nope, tax planning looks and says, how can we structure that so you're only pulling an amount out of your pre-tax so that your income stays below the threshold so that you can get premium tax credits on buying health insurance before Medicare, and you pull other dollars out of cash or cash flow, something like that. That's tax planning. Mm-hmm. Tax preparation is just looking at the result and putting it in the right box.
Yep. Yeah.
So tax planning is the creative stuff. It's the proactive stuff. It's the value-added stuff.
It's the part that you work into all the rest of your financial plan as well. Before you make a decision with your investments, before you make a decision with retirement or your estate plan, you stop and consider the tax ramifications so that you know the decision you're making is the best one possible.
All right. So then here's the question. Here's the question to you. What are the best tax planning strategies for this year? We're just going to share our favorites. Ryan, Josh, what do you got?
So there's, like I said, there's lots of different opportunities. A couple of the really good ones that are they're just important as far as timelines go. Reviewing the withholdings. So we talked about, the opportunity or the times when people their life is changing. So whether they've changed jobs, whether they're new to the area and moved, to a new state, just taking a second and reviewing that stuff and doing a tax projection to make sure that your new employer is withholding the appropriate amount of tax or the right state tax,
Oh, my
or make
goodness.
sure that they are withholding, a local tax. A
That-
lot of
that
these
happens a lot, doesn't it?
Yeah,
I mean,
it does.
every year we discover for someone that their employer that's maybe domiciled in a different
Right.
state, the payroll doesn't understand that in Indiana here you have a county tax as well as a state tax, and they're just completely missing it.
Yeah.
And it's always heartbreaking when we discover that after first meeting someone late in tax season, it's too late to do anything.
Right.
But if we can be talking about it during the year, we can be observing and calculating these things off of a pay stub. Maybe we can sniff that stuff out and reveal it soon enough to actually solve the problem.
Okay. That's important.
Right.
But no one cares. No. So that's important. Yes, and you need to do it, but that's not exciting. Here's the one.
You
This
didn't
is
say it
my
had to be
favorite.
exciting. This
That's
is
right.
tax stuff, man.
Oh,
Come
okay.
on.
Avoiding serious harm is exciting. Mike.
Yes.
Here's my favorite. Okay, so it's the health savings account. Okay, high deductible health plans, qualified high deductible health plans are becoming more and more prevalent as health care costs and health insurance costs here in America continue to go wildly out of control. And so, what's your way to control it is contributing to getting a qualified high deductible health plan and contributing to the HSA. So, a couple quick things. This is the same drum I'm beating. First, if you have a range of options right now to pick for health insurance with your employer next year, I'd evaluate the options from a cost standpoint and coverage standpoint, but then factor in the tax savings from contributing to your HSA. We've been doing this a ton lately. In the HSA, even if you have a unhealthy year, I've had a terribly unhealthy year, everyone. It's cheaper. Okay, so that's one. Just do a comparison. It's geeky math, but do the comparison. Number two, if you do have a qualified high deductible health plan, don't think ahead to say, well, how much medical cost do I think I'll have? All right, that's the amount I'll put in my HSA. No, do as much as you can. And if you've got the cash flow and it fits within your overall financial plan, max it out, do the limit. That's my
Okay.
favorite.
I've got a better one.
Good.
We've talked about it before. We've been banging this drum as well. The Roth conversion has to be something that you are considering right now.
Even with the market where it is?
It doesn't matter where the market is. You have to determine whether or not this strategy makes sense because you have to choose before the end of the year, right?
Right.
So every year you've got a window of time to decide whether it makes sense. I had a client in the office just a few days ago, and we were considering whether to make a contribution to a Roth IRA. They would be limited to $7,000 because they're over age 50, or instead, we showed them that the cash they have on hand could be used to pay the tax on a Roth conversion. We ended up shifting about $45,000 from a traditional IRA to a Roth, paying tax at a low rate today because we actually believe that in the future they're going to be in a higher tax bracket.
Josh, that is brilliant. The name of the game, if this is the name of the game for you, is just how do I get as much money in the Roth as possible, growing tax-free? That's brilliant. Use cash flow to pay the tax and do a conversion instead. So
We could only do that, though, because we ran a tax projection and we knew how far we could go with this Roth conversion, creating income on the tax return and pushing them up closer and closer to the edge of the 12% bracket. We didn't want to jump into the 22% tax bracket because we lose some of the economic benefits and It just doesn't make financial sense to go too high.
In their situation. Yeah.
Yep.
Yeah, I get that. So HSA using the Roth, and the Roth conversion's a creative way to do that. Love that idea. Last week we were talking about taxes as well, and talking about the new taxes that the government keeps pushing out, and both of these shelter against that. So what are our other favorite tax planning strategies you need to consider? We've got that and more coming up here on the Wise Money Show with Korhorn Financial Group. Okay, thanks for watching the show today. This is the Wise Money Show. If you're not already a subscriber to the YouTube channel, I'd encourage you to do that. You can hit that button right down there. And then I'd also hit that bell so that you're notified anytime we're pushing out new videos, whether that's every week with one of the Wise Money episodes, or whether that's one of our other videos, Next Wise Steps, or anything else. I'd encourage you to do that. And then lastly, hit a thumbs up, hit a thumbs down, share it if you want, and leave a comment. You like it, you don't like it, you've got a question, we want to hear from you. Thanks in advance for doing that. So. All right, so Ryan, this is a shadow busy season.
Mm-hmm.
Busy 6 months ago, you're very busy.
Mm-hmm.
Now, today, you're very busy because we're doing a lot of tax planning.
Mm-hmm.
Yep. Anything unique this year? Got a couple new tax preparers on the team?
Yeah, a couple new tax preparers on the team. That's been a good boost to the busyness of this season. We've done a lot of training with the new folks, and I've been able to help educate some of those other preparers so that they can, do a lot of these tax projections and help.
Yeah, it's that time of year. Tax season or tax class rather
Right.
is going on, and a lot of people are being cross-trained.
Yep.
I'm excited about some of the new experienced help that's also joining to be reinforcements
Yep.
for you. I'm
Yep.
thinking of Jared Moxness, one of our CPAs and financial advisors. He's kind of a dual threat like
Yep.
you are, and brings just a wealth of amazing experience from another firm in Chicago.
Yep.
But that's important because
It's awesome, yeah.
we're often running into scenarios where, especially with small business owners,
Yep.
things can get complicated real fast. And if there was ever a group of people that need to be proactive in their tax planning, it's small business owners.
That's a good segue. We're going to be talking about you small business owners coming up on this segment, and some tax planning strategies for you. So,
Yep.
All right,
Cool.
Let's get into it. What are our favorite tax planning strategies that you need to consider implementing for 2019? We're sharing that today. This is the Wise Money Show with Korhorn Financial Group. Thanks for being with us. My name is Mike Bernard. Here with me in the KFG studios, Joshua Gregory and special guest CPA Ryan Fair. Thank you to the attorneys at South Bank Legal as well as First State Bank for making the Wise Money Show possible. Appreciate that. Thank you very much. To follow all Wise Money content, you can find us online, wisemoneyradio.com, and then all over social media, wherever you're at, we're there too. Just search the Wise Money Show. You can leave comments, questions there as well. All right, we're into our favorite tax planning strategies for 2019. We've said double check your withholding so you avoid surprises. And I said that was boring, and I was right. But it's extremely important. Avoid penalties, avoid surprises. Yes. Then we got to the good ones, HSA, Roth conversions. What else? What are our other favorite tax planning strategies for individuals 2019?
All right, I've got a couple. So first, let's start by referring back to last week's show of charitable contribution planning. So specifically last week, we were talking about donor-advised funds. There's other areas to explore with charitable giving. So maybe a donor-advised fund isn't the best option for your situation. There's other stuff, though, that we can talk about. Bunching contributions. We can talk about qualified charitable distributions from your IRA. That stuff all has to be done before December 31st. You can't wait until you're in meeting with your tax guy to make those decisions in April. So now is the time to make those decisions, run the projections, see what else is hanging out there.
I agree, and those contributions often have limits as to how much you can deduct of your adjusted gross income.
Yep.
I don't know how you do that without a tax projection. So, Great point.
Another year-end deadline that we run into here in Indiana, those of you that have set a goal to help your kids or grandkids with college planning, we often talk about the Indiana 529 plan. It's called the College Choice Plan. That's the brand it operates under. But this is a tool, a type of an account that you can open and make contributions to it on an annual basis or just however frequently you want. And what it provides for you in Indiana is a 20% tax credit against your Indiana taxes. Okay, and that's on the first $5,000 that you contribute each year. So if you're doing any kind of help for the kids, maybe you have a son or daughter that's already a student in college or about to be, and you say, there's no point in starting a 529 plan. We're already in the college years. No, there's still ways that you can make a deposit and pull it right back out in the same year and still get this credit. So, this is important way that your investment planning, your college planning, and your tax planning all have to be merged together. It needs to be an integrated plan, and that way you don't miss out on these types of tax savings.
Yeah.
I've got one more that we can talk about, and that's capital gains planning. Capital gains or capital losses. So a lot of times you think, capital losses, I've got this stock or mutual fund that I bought that's a dog. I don't want to sell it now while it's low. If, depending on the prospects for that stock or that fund, there's a tax advantage to go ahead and sell that fund or stock at a loss. You at least get the tax benefit from that if you think that can help you out. Same thing with gains. If you've got significant gains, on stocks or funds, we can look at that and run projections and tell you exactly how much stock to sell or how much capital gains to capture and still stay in the 0% long-term capital gain tax bracket.
A lot of people don't realize that is a possibility, right? There are ways for you to sell some investments that have run up in value. There's a gain there or a profit when you go to sell. And some people pay zero federal tax on that.
A lot of people.
That's right. It just depends on what tax bracket overall you're staying within. And so if you have a year where you have the ability to harvest some of those gains, to neutralize the tax pain that's been building and building without really paying any taxes. Right. We don't know how long these 0% capital gains rates are going to be around.
Yep.
So don't miss a year where you have the ability to go ahead and wipe out the taxation efficiently. Don't lose sight that the state is not as generous with those tax savings, but that will always be there. The state's always going to tax you on those, I believe. But if you can get away with no federal taxes, don't miss that opportunity either.
That's right. And I'd remind you that all of those buys and sells inside tax shelters, that doesn't equate. It really is something that irritates my dad. Within the IRA, hey, if there was an investment that temporarily went down, I should be able to deduct that. No, you don't get to, Dad. Sorry. Just get mad at your son for that. I had nothing to do with it, but that's okay. All right. What about small businesses? If you own a small business, you've got to do wise tax planning every single year. For a lot of people, it's, what can I buy to make my profit look lower? Sometimes that's not a wise thing to do because of how these tax rules work. But let's just share a couple for those of you who own small businesses or are influencers in a small business. What are the tax planning strategies that are our favorites this year?
Yeah. So, Mike, actually, I had that down as something that I was going to talk about was the year-end depreciation planning, figuring out, what is profit expected to be? Is there a certain piece of equipment that you really need or could really help the shop or the business for future years? Does it make sense to buy that now or just wait until next year and buy it then? There's lots of different scenarios that we can look at with that and figure out when the right time to buy it is, when the right time to write it off is. Do we write it off over a bunch of years? Do we write it off all up front this year or next year? There's lots of planning opportunities for that. The other one that's really become important to plan around is related to last year's tax law, the Taxpayer or Tax Cuts and Jobs Act, and has to do with this QBI deduction, Qualified Business Income Deduction. So this goes hand in hand with your depreciation planning that we were just talking about, where you get a tax deduction for up to 20% of your business profit that it's a new deduction. You don't have to pay tax on that. So do you want to write off that equipment, which lowers your profit, which lowers the amount of QBI deduction? it all flows together, and there's a lot of opportunities.
In order to be a CPA these days, I think you have to be an algebra expert, because you're right. There's so many moving parts. You do tax planning the same old way you always used to, and maybe there's some inadvertent consequences elsewhere.
Right.
You're giving up some benefits that you would have otherwise had exposure to. If I was going to throw out another example, and I want to be careful in the way that I share this one, because this could be abused for sure. So hear this in the spirit with which it's intended. If you're a small business owner and you have kids that could be helping out in the business, maybe they already are, and maybe you make your kids go sweep the shop floor, or they've got to help out and you don't even pay them. Maybe you should be, right? Because it's very possible that you could be shifting some income or profit off of your shoulders and into their income bracket at a much lower tax bracket. The differential between what they would pay and what you pay is a tax savings potentially. Right. Mm-hmm. Now, there could be some drawbacks there. Maybe you add a little complexity to your life and theirs. So you have to make sure that it makes economic sense to do this.
Right.
But as they get closer to college, this could be a way, for example, to help them pay their own way for college by giving them a legitimate job to do within the organization.
Correct. Yeah.
And paying them well for it, so that they then pay the college bills instead of you.
A related topic, I'd like to introduce our newest financial planner at KFG, Easton Bernard. He's a swift 1.5 years old, and he's on his way to being a CFP. I'm just kidding. What were you going to say, Ryan?
No, I was just going to say that example that Josh said, that's a great way to start instilling financial knowledge, education, the financial skills into those kids that you have. So could be middle schoolers, could be high schoolers. If they're on the payroll and they are actually working, you then can take the next step and educate your children how to manage money, make them responsible with their money.
How cool would it be if at age 14 your parents got you going on your first Roth IRA, and you got an extra decade of growth over all your peers?
Yep.
What a blessing! What a launch in life that could be.
I've got one more tax planning strategy you need to consider. It mostly applies if you own a small business, but it may also apply to many of you individuals as well. And then we've got great questions coming up from some fans of the show: how to buy a car in retirement, and that Indiana 529 plan. So that and more coming up here on the Wise Money Show with Korhorn Financial Group. All right. What's the age limit for jobs? The minor employment. Is there an age limit? Do we know?
I don't think there is, as long as
not if they're family, right?
Working. Yeah.
Right. I mean, there's age 14 is kind of a magic age if they're just working for other people. But when it's family, I think there's more flexibility on that, isn't there?
I believe so, yeah.
I mean, you think about like a child model. Like they show up in certain publications, marketing material, whatever. And we've had clients who they do a photo shoot with their own kids modeling their products or whatever, and now the child receives a 1099. They've got earned income that year, makes them eligible to do the Roth contribution. It's awesome.
I also want to introduce you the new spokesperson of Korhorn Financial Group, Easton Bernard. He is 1.5. He is on his way to being a CFP.
Butt off, man.
He's almost potty trained. Just kidding. We haven't even started. Oh, that's funny. That's funny. But this is the creativity. We haven't said this in a while. Your CFP really should be bringing confidence and clarity to your financial life, but then also creativity. And not too creative.
Right.
No kidding. Get that away from the tax show.
But creativity for sure. All right, let's dive in. So I've got one other small one to hit. It when I realized, oh no, this really applies to both people, I figured, well, we're going to say it. Any others that you want to quickly mention at the beginning of the third segment?
Are you going to talk about retirement plans or contributions?
No, so you can.
Okay.
Just real quick, and then we'll get it. If we're transitioning listener questions at the 5-minute mark, I'll feel good. Or around there. So, all right, ready? what's the best way to finance or buy a car when you're in retirement? You're on a fixed income. Maybe you've got money in a 401k or IRA that when you pull it out, it's going to be taxed. Well, how do you buy a car? We've got that answer. Coming up, this is the Wise Money Show with Korhorn Financial Group. Thanks for being with us. My name's Mike Bernard. Here with me in the KFG studios, Josh Gregory and special guest CPA Ryan Fair. Thank you to Bethel University Adult and Graduate Studies, as well as Diane Bennett and the Inspired Homes team for making the Wise Money Show possible. Thank you very much. And lastly, let me remind you, if you're not listening on the YouTube channel, you can find the Wise Money Show there, every episode right there. Just go to YouTube, search the Wise Money Show, subscribe to it, hit that bell for notifications, and then leave comments, leave questions. You can share, you can thumbs up, thumbs down, all that sort of stuff. Thank you very much. All right, we're talking about our favorite tax planning strategies for 2019. We talked about it for individuals. Now there's a couple more for businesses that we want to hit, and then we'll transition into questions. This one is about as bad as the one Ryan started with. But I'm thinking about businesses and the profits for your business flow through, if you're an LLC or sub S, flow through to your personal tax return. And I don't know about you guys, but as I take a temperature with the business owners that I'm connected with, 2019 has been a good year so far, but for many, not quite at the same level as 2018. Mm-hmm. And if you were set up to pay estimates based on 2018 and you have some clarity that 2019 is not going to be as great, then you're probably trying to manage cash flow, and it may make sense to pay in less in a fourth quarter estimate. And by the way, the fourth quarter estimate's not due until the first quarter of 2020. So stupid. That is so dumb. Okay, but so tax estimate planning based on where you think your profits are going to be.
That's one of the biggest areas that we help small business owners in, right? Throughout the year, on a quarter-by-quarter basis, kind of taking a snapshot of where their tax picture stands compared to the ebb and the flow, the ups and the downs of profit from the business. And I'm a big believer. I don't like just setting quarterly estimates on April 15th and just putting them on autopilot, paying the same exact amount every quarter. I would rather see small business owners doing a calculation each quarter and paying the right amount, so that they don't get ahead of pace on their taxes and they don't get behind pace either.
Cash is king.
That's right.
Yeah.
Keep the money in the business as long as you can, but not longer than you should, right? You don't want to get behind on your taxes.
Yeah.
I'll throw one more out there, and this is a show about financial planning, right? And so financial planning lives, a certified financial planner is operating with you at the crossroads of 6 key areas of your financial life. So anywhere that a financial decision is going to impact more than one element of your financial plan, it gets my attention. And if there was ever an example of this, I don't think we can talk about tax planning for you as an individual or a business owner without mentioning the tax shelters available to you, like retirement contributions into IRAs, Roth IRAs, your 401k at work. SEP IRAs are another one that we don't give a lot of attention to because it applies to a certain segment of small business owners. But you need to know what is the best tax shelter for you to be building up resources for your retirement. Your retirement will be better funded if less of your money is going to taxes and more of it is left to be growing for your future.
I was meeting with a small business owner earlier this week, and we've been talking about starting a 401k for his growing business, and we're now in November here, and he said, it's time. And how long does it take to get this started? And I said, well, we're going to work with you maybe 90 days, maybe 6 months if there's lots of questions and lag time, but we should start now if you want to have one in place for 2020 until we've got an appointment on the calendar. So be thinking ahead and absolutely maximize your retirement plans. All right. Great questions coming up here about tax planning. And the first one, I've kind of teased it out a little bit. Lauren, 64 from South Bend. What's the best way to buy a car in retirement? Do I take cash out of my IRA or do I get a loan?
Great question. We get that one a lot. And boy, just like every single financial planning related
Yeah.
question, the answer is it depends, right? There shouldn't be just a blanket statement that applies to everyone who's considering this exact same question. But I would actually, if we had Lauren on the phone, I'd first be asking, are you drawing Social Security? Are you still working? Or are you already retired? And because at age 64, it's possible that you've already retired and maybe you're drawing Social Security. And Social Security creates a little bit of a wrinkle in the story problem. Because if you were to pull money out of a traditional IRA, you may inadvertently cause more of your Social Security to be taxable than you were otherwise going to experience if you just let the year finish out.
Yep.
And so how you pull chunks of money out or even a monthly stream of income out of your IRA is going to have an impact on your tax picture. It may have a multiplication effect if you start causing Social Security to be more and more taxed. So to me, the best answer here is to look at not only a tax projection for this year to finish out 2019, but even be considering 2020 as well. Sometimes the best idea that I've been able to offer to someone with the same story problem is maybe take a half distribution from the IRA this year and pull the other half of the cost of the car out January 2nd, let's say, and now you've got the money out of the IRA, but you've split it into 2 different tax years. Go pay cash for that vehicle in that case. Sometimes we need to spread it out over longer periods of time, and that's when you're using potentially a car loan or maybe even a home equity line, that sort of thing.
Yeah, I mean, and that's great. And the other thing related to Josh's questions about whether or not they're already taking Social Security, even if they are, a lot of times, Lauren said he was 64, so maybe his pension starts when he turns 65. So next year is going to look a lot different than this year. We can look at those different alternatives and say, hey, income is low this year. Next year the pension starts, it's going to be higher. Let's take more of a distribution this year to get that car. And yes, there's lots of different alternatives.
This is a question that you have to figure out, though, because
Right.
a lot of people think, well, if I can just get a new car at the beginning of retirement, I'll drive it all the way through retirement. When does that ever really happen, though, right? That might be what you're thinking, or maybe you'll get through a decade or two, but chances are you're going to buy more than one car in retirement, so you need to have a game plan for this. And to add just one more, component to the thinking here, you also have to pay attention to what is it that you're selling out of that IRA? What investments are you going to harvest the cash from? Are they investments that have been running strong for a lot of years and you can sell at a high point? Or are you going to be liquidating, investments at depressed prices just because you've got a car crisis on your hands?
A couple other things that I would point out here. I don't know if you guys are seeing this a lot. Number one, I really dislike buying vehicles. I don't know why. I just always feel like, I don't know, it's just not very fun for me. So I don't really do that often. But in talking to clients and even some friends who've bought cars recently, a lot of these dealerships are, if you're looking at a new car, which I think, Lauren, on the verge of retirement or in retirement, a lot of people say, I'm going to drive this car for all of retirement, and that's the reason why I'm going to get a really nice one. Yeah. No, just get yourself a nice car. If it fits in you don't need to justify it. But you get some sort of deduction on the cost if you finance it. We'll give you $2,000 off if you finance it with us or something like that. I think I'm seeing that more and more. And so that goes to the idea of, well, what if you take some out of your IRA this year, but you still get a loan so you qualify for a lower cost, and then take the rest out next year to pay it off?
There's a lot of people who it almost feels like they've lost or they've failed in some way if they have to use debt in retirement. Yeah. And the reality is many people still have a mortgage. Many people still use debt. Our preference would be that you'd be debt-free because then you don't have the obligations on your cash flow that create major constraints for your investment portfolio. But there are some times from a tax planning standpoint that using the debt in a judicious way, using it strategically to limit your taxes, you may save more in taxes by doing it right than what it would have cost you in interest.
That's right.
Especially if we're talking 0% financing.
Okay, great question about selling a cottage, not a primary resident, whether that's taxable. So we've got that and more coming up here on the Wise Money Show with Korhorn Financial Group. Little bonus content on YouTube here. I really wanted to sneak this out in the air. The question actually said 401k, and I changed it to IRA. I figured that applied to more people. But here's the problem with 401k. Oftentimes, in fact, the textbooks say every time you draw money out of 401k, you have to withhold 20% for taxes. And imagine if in this precarious situation we've already talked about with Social Security and, well, taking money out of the 401k is going to mean more of your Social Security is taxable, but I really only need to withhold 10% on this because I've done my tax planning and I don't need a lot withheld for taxes. But in your 401k, they force you to withhold 20%. That means they're forcing you to take more money out in order to get the net needed to buy the car, which is going to force more of Social Security to be taxable. This is one of many reasons. If you're in retirement, you've got a 401k, you've got to move that to an IRA. You got to. There's just lots of reasons to.
Yep.
So.
But you talk about an inadvertent or a hidden way that the cost of that car goes up when you pay tax on unnecessary distributions.
Yep.
So it's one of the reasons why most people, when they leave an employer or when they retire, they roll those retirement accounts over to an IRA where they have maximum flexibility on how much you pull out and how much gets used to pay taxes as well.
Flexibility on the investment choices and Roth conversions are easy and all that sort of stuff. All right. Let's get into it. We'll hit these two questions. The first one will probably be a bit easier, but we can talk about some of the rules again. So, thank you so much for being with us today. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFG studios, Joshua Gregory and special guest CPA Ryan Fair. If you missed anything, every episode of the Wise Money Show is on podcast. All right, we just air every single episode right there, comes out every single week. If you listen to podcasts wherever you're at, you'll find the Wise Money Show. Just search the Wise Money Show with Korhorn Financial Group, and I would subscribe to it so you're notified of all new episodes and you can binge listen. We hear that from folks all the time. Rate this show, comment, and even share. Thank you very much. All right, next great question comes from Dan. Dan's 59 from Napanee. Hey, should I contribute to the Indiana 529 plan for my grandkids? So Dan lives in Napanee, so Indiana resident, likely, depending on income. I don't know, it could be retired at 59. That'd be pretty early. Likely paying some Indiana tax. What do you guys think?
I mean, good grief. As one parent among three here, I'm saying what a blessing that you're even thinking about helping your grandkids with college. And, today's college students are facing, a struggle that maybe past generations didn't have as much just because of the known cost increases for college. So when they can tap into other resources like the generosity of grandparents, what a huge blessing, what a huge help that could be. The thing that I would point out is we've talked in the past about the Indiana 529 plan and the tax credit that it provides on your Indiana tax return. We have to pay attention to, do you have enough income on your Indiana tax return or enough tax to be able to absorb all that free tax savings that is on the table here? So we would want to look at your tax picture to know for sure if that's the best idea. But we also, there's a potential trap here when it comes to financial aid. And when your grandchild goes to college and they're applying for financial aid, they may or may not be eligible for financial need-based aid, okay? But if they were, what you don't want to do is accidentally create this resource that gets, I'm going to use the word penalized. That's not a fair statement, but it gets more heavy weighting in the calculation of need when it's money coming out of a grandparent's account, potentially.
It doesn't seem fair.
Right.
Sure.
Mm-hmm. So what some people will do, the year or two leading up to the college years, is they'll change from themselves being the custodian on the account or the legal owner of the account to the son or daughter, the parents of this student that's going to college. And that's one way to deal with that. But you're adding a little bit of complexity when that happens. but it's not something that's insurmountable. So, question of whoever is the custodian on the account, this 529 plan, they're the ones who will get the tax benefit on their tax return. So just pay attention to that and make sure that one tax return is not better than another, because maybe I've had some grandparents who it's better for them to just gift the money to their son or daughter and they set up the 529 plan. Yeah. And even if the son or daughter passed along the tax savings to grandma and grandpa as a thank you,
Yeah. Hey, Dad, father-in-law,
Yeah.
I'll pass along
listening?
some of the savings here if
Ryan,
we cut a deal.
Ryan, what are some of the limits here on 529 contributions, or at least to consider?
Yeah, well, I think Josh mentioned the biggest one, the taxable Indiana income. So you have to have enough Indiana, and that's the state tax, not the county tax, even though it's on the same tax return. You have to have enough Indiana tax liability for the credit to eat that up. In other states, we talk about Indiana because that's where we're located. There's lots of other states, if you're across the country, that you want to look into. Lots of states offer a tax deduction for the contribution. Deductions are still good. It's not as good as the credit, but they're still good. And then the real benefit is you get the tax deferral over time.
Yeah.
So if you put in dollars today, deferred over time as it grows.
And be aware of your state. It's not just the limit. There are national limits on how much you can put in. And I'll tell you, those rules are a little weird because you can borrow from other years and so on. But what your tax benefit is up to. So in Indiana, it's on the first $5,000. In Michigan, it's on the first $10,000. And so just be aware of that as well. And that's per tax return.
Right.
So a lot of time, I was meeting with someone this week, and they said, "Okay, well, I've got two kids, so I'll do $5,000 each." And I'm like, "Well, you could legally, you could, but the tax benefit's still $1,000. So even if you just did $5,000. So, all right, next question. Oh, love this question. Ken is 63 from Granger. Hey, I sold a cottage near Lake Michigan that we've owned for 10 years. So we bought it for $120,000, and we sold it for $180,000. And probably made improvements while we owned it of about $30,000. We're not supposed to use numbers on the radio, but what kind of tax am I looking at this year?
Yeah, so that's a great question, Ken. Looks like you've got a lot of the high points as far as information there. So obviously, normal situation, look at 180 is what you're selling it for. Your cost basis in this situation would be the $120,000 that you paid, plus the $30,000 worth of improvements that you've made over the last 10 years that you've owned it. So your cost basis now is at $150,000. If we stop there, and that's all the information we consider, you're going to have to pay long-term capital gains on the $30,000 gap between $150,000 and $180,000. But if we start looking deeper, $180,000 is the sales price. Most likely you paid a realtor, a buyer, the buyer side and the seller side to sell your condo or your cottage. You also paid the title company, the appraiser, the inspectors, on down the list. When you look at those HUD statements, there's all kinds of expenses on there. All of that stuff reduces your sales price from a tax standpoint.
Doesn't it feel like everyone has their hand on your wallet when you sell real estate?
I told you I don't like to buy vehicles. I don't really like to move either, buy and sell houses because I feel the same way.
Yeah, so all of a sudden you could be, simple math on a sales price of $180,000.
What do you assume? 10% goes to closing costs or something?
Yeah, because you're paying the real estate agents 6 or 7% typically. You've got all the other stuff, tax expenses. So all of a sudden you could have, an easy 18, 15.
Half your profit could be eaten up with these costs at the end. You're saying
exactly.
The other thing to consider, if out of this process of selling, there's after an inspection, I've got to fix up this railing, I've got to fix this up and that up. Those are all, they might not feel like improvements because you don't get to enjoy them, but it still costs to you.
They're selling expenses.
Yeah.
That comes right off of the capital gains calculation.
Well, and keep in mind that, we started with this huge profit that you were worried about, and now we've kind of whittled it down, unfortunately. But maybe it's a manageable amount of taxes that you're going to pay. It could even be zero, depending on what tax bracket you're in that year. So I wouldn't be too fearful, and yet Boy, I've had 2 clients in the past week where we were helping them run a tax projection because they both had real estate transactions this year.
Wow.
One is going to escape with no taxes. The other is going to pay tens of thousands. What's the difference? Different circumstances. How long did they hold it? How large is the profit? Here's another variable. What we don't know from Ken's question was this property ever a rental property? Like, was this a lake type property that was rented out to vacationers, or was it just used by the family? The difference is you may have been taking some tax write-offs along the way through what we call depreciation. It's a way of writing off the value of the house slowly over time, over the useful life of the house. But the problem is, when you go to sell that house, you may have to recapture it or claim that back on your tax return as income. That can blow everything we just talked about out of the water, right? So there's always, some sort of details that need to get caught in an actual tax projection. It's why it's not too late yet this year to be talking to a CPA and a certified financial planner to see if there's anything that you could be doing proactively to try to get yourself into a situation where you're paying a lot closer to zero than the big tax that you're worried about right now, Ken.
Josh, I didn't even think about renting this thing out. That's why, man, you are smart. That's great thinking, and you never know. That's why you just got to sit down. If you're doing TurboTax, I don't know how you figure this one out.
Yep.
If you're doing TurboTax, you probably list the sale price at $180,
right?
And you're probably paying more tax
on $30. Yeah.
So got to be careful out there. All right, great questions. That's all the time we have for today. On behalf of Ryan, thanks for being the guest the past 2 weeks.
Yeah, thank you.
On behalf of Josh Gregory and all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.